thank you for joining us. In this session, we'll be discussing financial and tax considerations for Americans moving to or living in Thailand with a focus on retirement. We have two expert panelists joining us. Thomas Carden is founder and international tax director at American International Tax Advisors, which provides US tax advice and services to Americans moving to or living in Asia, Australia, and Brazil. He is enrolled to practice before the Inland Revenue Service and has over 25 years of tax and financial industry experience. He has a bachelor's in global business management from the University of Phoenix and a Juris Science Master's in International Tax and Financial Service Law from Thomas Jefferson School of Law. He resides in Thailand. Tom Zachystal is Chief Investment Manager at International Asset Management, a US registered investment advisor specializing in financial planning and discretionary investment management for Americans living abroad. Tom has an MBA in global management from Thunderbird University in Glendale, Arizona, holds the Chartered Financial Analyst credential, and is a certified financial planner practitioner. Tom lives in the San Francisco area, having previously lived overseas in several different countries for many years. He has been providing investment advisory services to American expats for over 20 years. If you would like to, following this presentation, schedule a consultation to discuss your personal financial planning or investments or tax situation, you can do so via aitaxadvisors.com or iamadvisors.com. Before we get started, please note the webinar is for informational purposes only. It's not intended to offer advice or guidance on legal, tax, or investment matters, as such advice can only be given with full understanding of each person's specific situation. So that out the way, let's jump in with Thomas.
Hello, ladies and gentlemen. Again, I'm Thomas. I'm going to try to give you some general background on being an American here in Thailand, as well as go through some of the stuff with the Thai tax changes as well. I know we've already gotten some questions come in advance on that. And I know there's a few people out there. One of the questions came in about Australians. We can answer those through the tax questions on this. But you're going to find the first part of this will be a little bit specific to Americans. However, we are going to do a lot of stuff on Thai taxation in general and how to deal with the new Thai tax rules with this. And one of the things I want to start off with this, especially if you are retired. Thailand is thinking about moving here. Thailand is a fantastic destination to retire to. The cost of living is relatively low. Healthcare is absolutely fabulous. Your lifestyle will generally go up with this. A lot of people have complained recently about the new Thai tax changes, but they're moving into the system that most other nations do with this first and foremost. The compliance costs that will probably be minimal. You're not going to pay tax twice. It's just going to be where a certain country taxes you that'll become the big issue, with this. Okay, Hugo, you want to move the first slide for me? Okay. So the contents of this are going to be pretty simple. About us, Hugo's already gone through a little bit for that. Tax exclusion and credits as an American living overseas, Thailand tax brackets, practical tax strategies on if you're living here in Thailand and how you're going to receive all these incomes, tax treaty benefits, and then finally I'm going to go with the scary part as an American, PFIC and FATCA taxation, which is where Tom is going to help out a lot on making sure you manage your money properly with this to it. So let's go to the next slide. You go. Okay, again, I have to take my own horn here, but I've been doing this for over 25 years in tax and financial service industry. My actual master's degree is in international tax and financial service law to this, which has been a very big boon on this, especially because the tax treaties are becoming much, much more important here in Thailand with this. And having dealt with the Americans using the Thai tax treaty, we're dealing with everybody else in this too. We are lucky we now have a staff member who also has an LLM from Queen's Mary Law School in London. And she has literally been asked by the Thai authorities how to help them read tax treaties in this. So the world is becoming much more important on everything we're about to talk to if you are living here in Thailand. But however, don't let that be a a factor of not thinking about moving here. Your compliance costs are going to go up slightly, and you have to file a Thai tax return if you're here, but it's not going to destroy you. You're going to find, again, your cost of living is much, much less than just about any developed country. And many of the services here are equal to or better. Again, I'm going to go through healthcare at this, but the healthcare here is unbelievably good with it. It's not perfect as it is not perfect anywhere, but the system here is very, very good as well. So I don't want to in any way discourage you from coming into Thailand and retiring. We've got a bureaucratic hiccup here coming up, which is what my firm helps you do. We file both U.S. tax returns, and we have a full Thai division that is dealing with tax ID numbers and everything for filing the Thai tax returns as well. We have offices in I think about 12 other countries now. Thailand's our home office, but this is where we are, and this is the only country that we do both sides of the tax returns for with this. Okay, next slide. Okay, we do everything as a service here: individual tax returns, corporate tax returns, filing your FBAR, very important, foreign earned income exclusion, multiple years past due tax returns, fixing tax returns, correcting balance and fees, disputing IRS adjudications, stopping delinquent return assessments, and avoiding criminal investigations. I will tell you that if you are one of those people who's been hiding money overseas, you're getting a lot more difficult on avoiding criminal penalties with this. Come in now if we can help you out. But if you also haven't filed tax returns in many years in the US, we are the experts at getting you done without any penalties. There's currently a program called Streamlined Filing that allows you to file past due returns in only 3 years of those returns, and you will avoid penalties. You do have to pay any interest on tax due, but oddly, if your income is international, that's not really common. Most of the time, this is a paperwork issue to you. Don't be afraid. Give us a call. We can help you get those things done and get you clean of this. We have a lot of people come in and like, I haven't slept for years about this, and they find out that it's not nowhere near the pain they thought it was going to be. We can help you out with that. Next slide. Okay, this is part of the reason why this is not as much painful to people as they think it's going to be. Okay, you have two separate things when you live overseas. Okay, that help you massively reduce your tax on your foreign income. The first is the foreign earned income exclusion. Okay, with that foreign earned income exclusion, you can, and for 2024, you will be able to exclude $126,500 off of your foreign earned income. So that means wages or self-employment from US federal taxation. If you are self-employed and you are not in a country that has a Social Security agreement, you could owe Social Security to this. Thailand is one of those. But otherwise, you'd be free of federal taxation, but not the self-employment tax with this. So, you're working overseas and you haven't filed your tax returns, you can earn 126,500 in 2024 plus 12,500 your standard deduction, and you don't owe any taxes to this. You're in a good situation. Now, in order to qualify for that test, you must be out of the country for 330 days or a bona fide resident of another country. Bona fide resident means doesn't mean you moved in May and you're residing in that country to this. You need to have moved to this country, been here for at least, have moved at least the prior calendar year, and you have to have your family and issues here. I will say that this is, people question this, and a lot of tax preparers won't use that test because it doesn't seem hard enough. But the IRS is actually pretty good. It is, and in many ways, it's clear as mud because you can't find it. But practically, there's certain tests you can look at. You're here on a visa. You've been here for a certain period of time. You've moved your family here. So they've never challenged us when we've used bona fide residence with this. But if you've got that question, give us a call. We can help you define what that is. Okay, but especially for retirees, more common because that income has to be, again, earned for work. It cannot be passive income. But there's also foreign tax credits as well. Okay, so if you have overseas income and passive activity, anywhere, if so, you lived in the UK for a period of time and you've got a lot of assets there. Okay, and you're paying UK taxes on that money, you can use that tax liability to offset the US tax liability. So if you're making 100,000 pounds and the UK is taxing you at 25,000 pounds and the US would say 20,000 pounds on that, you can write off the 20,000. You can use the 25,000 pounds to eliminate the tax in the US of 20,000 pounds. And you can carry that foreign tax credit into the future if you happen to move into a state on income that has less taxation, say the Middle East. So those tax credits can build up for you from one country to another. So if you do have Thai income or you set up a business here and you're paying taxation here on that Thai income to this, you can write that off against your US tax liability. Only until you, because let me start again on this one. Thailand has, for most of the tax brackets, pretty much equal taxation. They do tend to start those tax brackets at a slightly lower amount with this, but only up into the highest tax brackets in the US, and I mean the highest tax brackets, do you really hit an excess of that. Most of the people we have who work here or invest here and do those kind of activities at literally only the highest levels, and this is hundreds of thousands of dollars income a year, do they owe a couple $1,000s into the US if they're living overseas and working and doing this. Now, we're going to go deep into pensions here later on this because a huge amount of the people are retirees. This doesn't really work for you. We'll have to use the tax treaties later on. But should you be one of those guys who's still actively working, you're not going to be double taxed. You're only going to pay taxes to the highest rate of whichever country that may be. But generally, those are pretty close to being equal, guys. So it's not really a burden. What you're going to find is this isn't something you can do on TurboTax. You've got to do this smartly and use a professional like us, helps you do that. Okay, next slide. Okay, now here's for the terrorism part of being an American, the joy of this. Okay, your current rules of doing things wrong. Okay, you've gone forward a little bit. You go. We go back one more. There we go. Okay, you've got there are criminal penalties for trying to hide money overseas. Do not even think of doing that. You can go to prison. The head of Thai Beanie Babies, most people don't realize, went to prison because he was hiding money overseas, and they are getting much more aggressive with this. Okay, then you get all sorts of penalties for just how you file. Failure to file penalty, failure to pay penalties, accuracy related penalties, failure to file Form 8938. A big one is 5471, which is if you have a company overseas. There's an FBAR penalty, which is where an FBAR is where you disclose all your accounts overseas. And then there's a Form 3520 penalties, failure to file penalties, which is if you've got a foreign trust with this, there's all sorts of issues with this. And then, on top of it, if you owe any tax, there's interest due. Now, again, if you come clean and you use streamlined filing, none of these penalties will be assessed with this. So if you haven't been filing, come talk to us. We can fix this. But also, if the more complex your life is overseas, the more you need to use somebody like us, because you can stumble into these things and not do this properly over and over again. Again, living overseas as an American is not something TurboTax is going to do for you in any real way. And believe it or not, at one point in my career, I worked for TurboTax as an tax expert, helping them deal with their international stuff, but they were just about to throw up their hands because it just doesn't have the ability to do this. Okay, next slide. Okay, now we're going to go into, we talked a little bit earlier about Thailand tax brackets. Okay, so as you can see, they kick in a little bit lower. Up to 150,000 Thai baht of income anywhere is exempt from Thai taxation. That's essentially your standard deduction. Works out depending on a little bit under 5,000 US dollars, depending upon the exchange rate moving around on this. And then just under 10,000 is 5%. 10% for 500,000 baht. So you see here, and sorry, I want to point at the screen, but you guys can't see me pointing at the screen with this. You hit the tax brackets a little bit lower to this. So generally what happens is these tax brackets are fairly equal to what the US, but they tend to hit them a little faster here. But this is really only on Thai sourced income in most cases. Okay. There are visas and stuff with this, but again, we're going to go in tax treaties specifically for Americans and discuss some issues on how to minimize your Thai taxation here. Next slide. You could hear that next slide? We're still, okay. We're going back. We've gone too far a little bit here. The next slide. Okay. Now we're going to go into practical tax strategies on how all of this works with this. There's three ways to really minimize Thai taxation to this, and then we're going to go through how the treaties will work as well. Okay, one of the things I talk about this on minimizing your global taxation when you're here in Thailand is this is a whole lot like shuffling cards and when you shuffle cards and how you shuffle this. Proper planning on this can make this a tax haven for you in many respects. Okay, but it does that. You want to do planning on this. It makes a big difference on how you do all of this, because timing on when you move investments and how you move investments and who you move your income to makes a big difference on how all this is going to work for you guys with this. You can retire at a very minimal tax strategy here for most people with this, but strategy makes a big difference on how you're going to do this all the way around, because there's some things to this that make this important. Let's go to the first slide, residency. With this. Next slide. Okay. Thailand currently, and they're talking about changing this, is under a territorial tax system. Okay. Now, when you are bringing in overseas income, this is a key to this. It only taxes funds brought into Thailand. This is called a remittance basis of taxation with this, which means if you make $1 million overseas one year and you bring none of that into Thailand, Thailand will not tax any of it. If you bring that money into Thailand at a later date, they can tax that. They tax that money back to it. Now, prior to September of last year, they had a wacky rule here that said if the money was held outside of Thailand for 1 calendar year, it was not taxed when it came into Thailand. It had transferred to savings. Okay. How do I describe this? That made Thailand a paradise for retiring for tax purposes, because what everybody did was they would pour any type of income they had into a savings bucket and then pour money out of that savings bucket that had been in there for 1 year to this. So you could effectively schedule this in a way that did this. Now, we had clients who went into the Thai revenue office and said, hey, I took my pension out and I brought it immediately in Thailand. That loophole was so large that the Thai offices did not even know how to tax it. And we literally had clients who were told, leave, we don't know how to report that with it. One of the wacky quirks of Thailand. However, in September of last year, they got rid of the 1-year savings rules. And I can tell you, it is getting much more complex to live here with bringing foreign income in. But this is where we come into this. But if you don't bring any money into Thailand, or you don't bring money into Thailand in a year that you are tax resident on this, you are not taxed on it. So you can, most people, what they do is just bring enough to live off of in Thailand, and that will be is generally considerably less than what they actually, make in income with this. Let's go to the next slide. We'll start by talking about how to move that. Okay, this is the first and the foremost and the easiest way to handle your Thai tax situation. Okay, an individual who spends less than 180 days Thailand during a calendar year is not subject to the tax on remitted funds. Okay, what this means, and you can see this in the next line. Thus, an unlimited amount of funds can be brought into Thailand when you're staying less than 180 days, means no tax on foreign income. So if you are looking at retiring into here in Thailand and moving into Thailand in January of next year, you want to come visit and open up an account and bring as much money in before next year. You have an unlimited amount of money to do that. Should you want to go in and buy a house or a condo here, move it in this calendar year, when a year you spent less than 180 days. Should you want to buy a condo next year and you're not going to move in until next year, think about spending less than 180 days in the country. You have no tax residency in Thailand. It really is a simple way to do this. And one of the great benefits of this is, you are so close to so many other fabulous destinations. Bali is an incredibly short flight. You can go to Cambodia for, a couple of weeks to a couple of months. You can you can stay in Malaysia as a tourist. You go Hong Kong, Singapore. You are close to everything here. Spending 180 days outside the country, if you can afford to, or if that is going to save you a tremendous amount of tax, is a very, very valid strategy to this. But one of the things to do is, if you haven't moved here yet, but you are planning on moving next year, come visit, open an account, and just move the money into a Thai bank account that would allow you to buy that condo and do it in the future. Like, you have no tax consequences. Next year, you will only have to report the interest received on that tax. And if you haven't stayed 180 days, that tax is withheld automatically. You don't even have to file a tax return to this. This is the easy greasy way to avoid the new rules in Thailand on taxation to this. However, it does catch you up a little bit on taking money out of an IRA or 401k. But again, I'll go through that in a little bit. But this is where you start shuffling cards and how you're dealing with things to this. Okay, next slide. Okay. The second easy way to do this, I know we've got a lot of people here who are here in Thailand and wondering about this, is gifting with this. Okay. This is a loophole that not quite as big as good as the old one was with the 12-month rule to this, but currently you can gift up to a wife or a spouse or a descendant up to 20 million Thai baht per year. Okay. And that's per person with this. So if you do have a Thai child, you can do this. Now, that's an extremely large amount of money. Now, and that's again up to. Now, you can transfer to a non-family member, i.e., a girlfriend, up to 10 million baht. Now, the key to that word is 10 million baht. Okay. So you don't have to gift 10 million baht. You can gift, 200,000 or a million baht to your spouse and or girlfriend, and she can pay the rent. She can pay for food. She can pay for cars, and she can, do all those kind of things. And should it be your spouse and you trust your spouse for a long period of time, you can have her put the house in her name, which is generally the easiest thing to do if you're actually going to go in real estate. And you get what's called an usufruct on that property, which allows you to stay in that property. Right now, if the house is in her name to this, you are able to do that, and the gift is free of tax. Now, according to the rules, and we've been talking to the Thai authorities about this, that means that literally you can be sitting next to your wife here in Thailand, and as long as that money is coming from your account overseas into her account here, it's free of tax with this. So, don't transfer it into her name and then transfer in. You got a lot of extra paperwork with this if you do that, because then she's got to justify the gift overseas. But it's a lot easier to justify it if it's come from your name into her name, and we can show that wire process with this when they have to do this. Okay. And then there's also special for education. I believe it's unlimited. Religious or public benefit gifts to the different temples and stuff are also free of tax with this for gifting to this. But you can do, the 20 million Thai baht for anybody you're related to should handle most needs in this country. But again, if you go back on this and say, hey, wait a second, I've decided I want that 5 million US dollar penthouse somewhere to this. Clearly it's over that, and I want that in my name. Spend less than 180 days in this country and you're going to do it. Now, one of the things they've talked about here, and they have not given any detail on this, is the term pure capital. Okay. Pure capital brought into this country is not going to be subject to these tax rules with this. Pure capital could theoretically mean I'm putting capital in to buy a personal capital investment like a house. It definitely means investing in a company or a business, but they have not clarified what that means on an individual basis. The idea of that being a house yet is speculation. There's arguments for that, saying that that's a capital investment, it's a personal capital investment, but we're asking for a revenue ruling on that particular question yet. Again, that's one of the unanswered questions that are out there. Stay tuned on this, and try to subscribe to these types of things with us. We do a lot of YouTube videos, and you can follow on that. We'll keep you updated on what's happening with that. Okay, next slide. Next slide, Hugo. Okay. Okay. Now here is the big benefit of this. Okay. You can, as a non-federal government employee, using the Thai tax treaty, withdrawal out of U.S. pensions free of U.S. tax. And if you play your timing right and you do things on the other side, you can bring that money into Thailand free of tax too. Again, this is going to be a lot of card shuffling in how you do this. Okay. Now, I specifically in the slide have the word IRA and 401k withdrawals, and you heard me use the word pension earlier to this. Okay. For tax treaty purposes, pretty much anything that qualifies is reported on a 1099-R is free of U.S. tax with this when you use the U.S. tax treaty. I know how to describe this to give you a clarification. Do not try this at home. I'm giving you incredibly simple designations on this. The legal writing that has to go with that withdrawal on using a tax treaty is something you have to come to us. There's a real expertise to this. And if you get the language wrong, even though this is valid, the IRS will not accept it. One of the joys of U.S. bureaucracy. The wording on this has to be very, very exact, and then they accept this. But getting it wrong, and they will tax you and penalize this in the language. Don't try this at home. Next slide. Okay. Article. This is the gist of this to the easy part of this, and this is very, very high level. Do not try this again at home without coming to a very high level firm like us with this. Okay, subject to provisions of paragraph 2, Article 21, government service pensions, and other similar remuneration paid to a resident of a contracting state in consideration of past employment shall be taxable only in that state. Now, I'm assuming you want me to translate that to English instead of no tax treaty speak to this. Okay. Subject to provisions of paragraph 2, Article 21, government service. Okay. Article 21 talks about government pensions. So if you are a federal government employee, okay, you are subject to 21, that stays taxable in the United States. But IRA, Sept, Simples, Kios, Roths, and all those other types of activities would qualify for for that word pension that you see in the middle of that statement and other similar remuneration. So again, anything that comes on a 1099-R with this, paid to a resident of a contracting state. Okay, for purposes, that means resident. If you are living here in Thailand, paid to a resident of Thailand in consideration of past employment. Again, that's any type of retirement program to this, shall be taxable only in that state. What that means is paid to a resident of Thailand is taxable only in that state. Okay, so this gives Thailand the sole rights to tax your retirement accounts from the United States. Okay, with this. Now, again, we go back into the remittance basis issues on this kind of things and the gifting and there's one more exception that's a big one that we're coming up to on this. So if you stay in the country on less than 180 days in a year, you remit that income that you've taken out as a withdrawal, you are free of Thai tax as well. Now, however, here's going to be the catch-22 of this. If you are using that program, you have to be resident of the contracting state during that calendar year to take the distribution on your IRA or 401k or other private pension in the United States with this. You then, if you want to remit it into Thailand free of tax, the next calendar year, don't spend 180 days in this country because the taxes have already been clarified in the United States. It doesn't have to be remitted in to use this. You are free of tax that calendar year in the United States. It's not taxed here. And then when you bring it in the next calendar year, if you spend less than 180 days here, you are not tax resident and you can bring in an unlimited sum of money. Again, shuffling cards, guys. However, again, very specific language. Call us in advance. We give a free half-hour consultation for anybody who's doing this, thanks to IAM sponsoring this with this. Call us and talk to us in advance and ask questions of us. That's the type of thing where I give you yes, no answers. I don't sit there and use it as a sales call to this. But you can retire. You can take all that money out of those things free of tax here and free of tax in Thailand using that basic strategy to this. But again, don't try to do this on your own. Very, very complex legal wording has to go with all of this. And there's very specific sets of the process with this. Let's go through the next slide with this. Now, and this is just a little bit of this. Okay, using this, an American can access their retirement plans from age 59 and a half years old. 10% early access penalty prior to that. Tax is normally based on income brackets up to 37%. Using the Thai tax treaty with what I talked about, because the Thai tax treaty effectively states this is free of taxation. The 59 and a half rule goes away. No 10% penalty. Under the Thai tax treaty, it can be drawn penalty free in the U.S. And the U.S. citizen is taxable if their primary abode is in Thailand for 180 days or more during the calendar year. To it. So you got big benefits to do your retirement planning here in very, very large ways with this. Okay. And next slide. Okay. Okay. This is notwithstanding provisions of paragraph 1, including a lump sum payments, other payments made under a pension retirement scheme, which is a public scheme, part of Social Security system or contracted party, therefore of. Okay. One of the wackier things about this is, I think actually this is a slide that was put in incorrectly from a different one. I apologize. Now, one of the big benefits of this too, though, is we can go ahead and go to the next slide with this. Oh, that's the Thai tax treaty. Okay, sorry. Let me go back. Let me hold off for a moment. I was reading that as the U.S. side. Okay, I'm going to add one bit of point on this. Okay, Social Security in the United States stays taxable only in the United States with this. However, if you withdraw it if you only have pension income with this and it is free of tax, you have no other taxable income, so your Social Security in there is free of tax as well. Okay. Now this is where the strategy for everybody else, and I know we do have some people in here because we had some Australian questions on this, kicks in. But this is also the way to avoid Thai taxation should you choose to be here in a long time. Because what you can do is you can daisy chain tax treaties. Okay. If you're resident in Thailand, you can take an unlimited amount of money out of US pensions, okay, to this. But your problem is if you're remitting straight into Thailand, you are going to be taxable here in Thailand with that. Okay. However, Thailand has a second tax treaty, with another tax treaty with a country. I think there's about 68 or 69 of these things with this. We're having to review all of them at this particular moment because of the Thai tax changes. But there's another tax treaty, and you can effectively daisy chain your tax treaties because the Hong Kong Thailand tax treaty has an interesting thing that says under Article 18, pensions, and this is paragraph 2 specifically, notwithstanding the provisions of paragraph 1, pensions, including a lump sum payment and other payments made under a pension retirement scheme, which is a public scheme for which is part of the Social Security system of a contracting party or local authorities thereof. That's not what we're talking about. Part B is an arrangement in which individuals may participate to secure retirement benefits, which is recognized for tax purposes in a contracting party shall be taxable only in that contracting party. What that means is, should you choose to roll your IRAs or 401ks or any other type of funds into a Hong Kong-based pension with this, and I'll go in a little more detail on that, you are taxable only in Hong Kong, not taxable on the distributions in Thailand. Now let's go through the logic of this as an American. Under the Thai tax treaty, pensions, and that's not just a US pension, that's a pension anywhere, are taxable only in Thailand if you are resident in Thailand. Okay, so a Hong Kong pension, strangely enough for you, is also not taxed from the United States. But a Hong Kong pension also has the added advantage of being free of tax here in Thailand. So proper planning on this would allow you to move money in unlimited amounts of money. Now, again, complex, don't try this at home and Google a Hong Kong pension company. Many of them aren't going to deal with you because of what we're going to talk about later on, FATCA and PFIC taxation. We do have experts that can help you set up and run a Hong Kong pension that meets all the proper rules and requirements. So, there's cost to these things, but they do allow you to retire here very, very tax efficient. And I'm going to use that word very specifically. This isn't tax avoidance because these rules are set up for specific reasons and they're all legal tax treaties. This is all black and white. We state all of this to the IRS. and we state this to the Thai tax authorities. This is all done, and it's just done. What we've done here over the years is we've moved the level of high level planning you've heard about from past people into making this to a, the average person can afford this to this. And one thing I'm going to give a credit here to this is when you find out that you're going to move overseas, one of the things you're going to have a very, very difficult time is finding financial parties that will want to deal with you. International Asset Management specializes in helping you guys deal with the investments and gives you advice. Many advisors will run away from you like crazy to this. To give these guys credit who are coming up after this, this is a really rare skill set, and they are dealing with you guys to this, with this. And let's go on the next slide and deal with part of the reason why that comes in here. You go. Okay. Now, one of the things you want to avoid at all costs when you are overseas or you have money overseas is what's called a PFIC. Okay, passive foreign investment company. Okay, what a passive foreign investment company is, and you've got a little bit of the stuff down to this, a technical description of this, effectively is any type of pooled investment. So it's a mutual fund overseas. Now, you can have a Fidelity fund, in the US, and oddly, you can go buy the matching Fidelity fund in the UK. Now, what people were doing in the 80s were they realized that they didn't have any tax on dividends and interest if it was paid in a UK fund because it was all sort of tax deferred. So the wealthy were going into the UK and buying the clone of the mutual fund in the US with it. Okay, they created the PFIC fund. Now the PFIC is horrendous because one of two things happens. Okay, each and every year you own a foreign mutual fund, you get taxed on it as if you have sold it, regardless of whether or not you've sold it. So you've got a capital gain. If it goes up just based upon the currency exchange difference, you will pay a capital gains onto it, and then you'll have a loss. And you can take losses only against other PFICs. Okay, that oddly strange enough is the best option on this to this. If you do not choose that method of taxation on this, you are subject to the highest rate of taxation, 35%, plus interest back to the date you purchased it when you sell this. So if you've had that investment for 10 or 15 years and the interest rate is calculated, say 3% per year on 15 years, you own 45% interest plus the 35% tax bracket on PFICs. Do not do this. Okay. Now here's the good news on this, guys, though. When the money is held in a pension, the IRS has ruled that PFIC taxation does not go. You can have international asset management pick mutual funds for you from anywhere in the world that they have their stuff with, and allow them to help you manage your accounts with this. And you can buy individual stocks or bonds or anything with this and not have to worry about PFIC taxation. This is one of the big advantages of being overseas. You have a lot more international options on all of this when you use that Hong Kong pension. And yes, in that Hong Kong pension, there are platforms that you can use, and you can invest in US stocks and US mutual funds as well. It's a very, very powerful tool when you live overseas to be able to do this here in Thailand. And you can't do that in most countries. You can only do this in Thailand or a country where it says that the US does not have rights to tax that pension. That's very, very rare. And especially to have it still on the remittance basis of taxation and not be free of tax here. So, you can do planning on this, guys, and this can become a bit of a tax haven for you. Okay, next slide. Okay, and this is what we just talked about. Accounts held and pensions are not subject to the PFICs. This is a really, really powerful tool to this, with this. So, you don't want to mess with PFICs unless you've got a shield of a pension. Now, one thing about this too, and I should have mentioned this a little bit earlier for the Americans back in the room on this, the annuities are subject to it. There's a separate line item for annuities, but annuities are treated just like a pension, so you have the same tax protection as well. So if you are getting variable or fixed annuities, not taxable in the U.S., taxable only in Thailand. With this, next slide. Okay, FATCA. Okay, one of the things that trips people up on this is what's called FATCA. Now, FATCA is not a very large deal as if you are actually filling out the FBAR form. Okay, and we're going to start back in 2010. The Foreign Account Tax Compliance Act is passed. What this act did was it forces all foreign financial institutions to report the highest account balance you have in that year and activity of U.S. citizens or face a 30% withholding on international wire transactions. What that did was it forces everybody to fill out their FBAR form, and it forces all financial institutions around the globe to report your transactions. And again, this is I'm going to toot the horn of international asset management on this on a regular basis. Most foreign financial institutions do not want to deal with you. You really have to find the very few financial experts, in the U.S. that will help you handle, financial advice and services with this. IAM has done a lot of work on helping you guys do this. So they've got good services. They don't actually do the accounts. We can help you. I can help you handle the stuff from if you want to go foreign. They can help you handle U.S. trust and find those service providers that will hold that as well. Okay. So now in 2016, Thailand signs an intergovernmental information sharing agreement with the United States that requires the government of Thailand to locate all U.S. citizens and identify them back to the U.S. That means if you do open up a Thai bank account, you're going to be subject to they are going to report that back to the U.S. to this. Now, the catch-22 of this is for foreign financial institutions. You're going to find it difficult when you go open up a bank account when you go overseas with this. The foreign banks don't want the cost to deal with you. And I mean, I've been resident here. I have a Thai wife. I have the Thai pension system due to tax issues here in Thailand. It won't be taxed in the U.S., but because I'm a U.S. citizen, I can only buy Thai mutual funds that have Thai stocks in this. With this, you have more flexibility if you go into the Hong Kong issue. With this, but proper planning does that. Now, IAM I can help you set up the pension. That's a separate company. We don't actually do that, but I can refer you to the company that does. But you can then invest back all in the U.S. and have IAM help you, pick those investments and manage your investments for you, with this. Next slide. Okay, yeah, here you go, guys. This is why bank secrecy doesn't go into. We talked about earlier about illegal stuff. If you have undisclosed accounts, come in and talk to us. If you've been living overseas for a lot of years, don't be afraid. This is really common. Unless you are literally criminally hiding tax money, which is not the case of 99.9% of expats, we can help you get you clean in the U.S. standpoint. There are ways to do this. However, one thing I will say is the IRS has threatened to close that program several times in the past. With COVID, they slowed down that process. They may say that this is gone in 6 months. If you do have unfiled returns, get a hold of us, because the FATCA penalties for not filing your FBAR are 50% of the high balance of this. So if you have $200,000 in undisclosed overseas account and you don't come clean with this and they discover it, the penalty can be criminal, but the penalty will be 50%. But right now you can be penalty free on this. Do this. I always have to harp on this, but we still have people who don't know about this, and it's an issue to this. So talk to us if you've got tax problems. If you're worried about this, you got to do planning. Come in. Again, because IAM helps sponsor this, we're giving everybody a free half-hour consultation on this. No questions asked. We'll sit there and talk to you and give you yes and no answers about your specific situations. Next thing to it. Again, here's our website with this. To this, admin and AI tax advisors with an E at the end. There is an O. But his gentleman, it's actually AI is his name. To this as initials, but we are with an E. To this, and we can help you out. Everything is confidential, and we can help you out with this. To this. One of the things about this, though, is, guys, especially with the Thai tax changes, this has gotten more complex from a Thai standpoint. But for most people with proper planning, they're going to owe minimal to no Thai taxation on this thing. And at the very least, if you're just using the Thai tax treaty, you're not going to pay any more tax than you would in the U.S. with this. It's still a retirement paradise. And again, guys, this place is absolutely fabulous. I have been here for full time for a little bit over 8 years now, and been coming to this country for about 14 with this. It's a really fabulous plane. I get to sort of introduce Tom here a little bit again. They have a very, very rare skill set in that they're helping you guys. Most advisors, when they find out you were living overseas, will run away from you. We had two gentlemen who came in from Hawaii, and they kept their accounts with one of the brokerages there. I won't say which brokerage. They called in one day, the customer service line, asking a question. It came out that they were living in Hawaii, that they were not living in Hawaii, they were living in Thailand. They immediately froze the account. They then said you can only sell and withdraw funds, and they went to fire their advisor for not telling them that their client was living in Thailand. They had never informed the investment advisor with this. He had no way to know because they still had a valid address in Hawaii. That's the level you end up with of absurdity on this stuff. If you're going to live overseas, or you currently are, it's a rare skill set to find people who do what IAM does, specializing in this. To this, I can't give them enough credit for going through the detail and working through all these policies to this. To it. So, I do want to give these guys a round of applause and let them talk to you. And there are all sorts of trust rules you can deal with. If you've got a Thai spouse, an American trust is a possibility, not really tax advantage. You can use that pension trust and help out as well. If you talk to the combination of the two of us, you're going to be better off than trying to be out there in the darkness in the woods, so to speak, with this. You can save tax, you can do better planning, and be more efficient rather than on the outside of this. And I think Hugo's probably like, I think he's running out of time. I think he's running out of time with this. There's a lot of questions. We'll try to answer as many as we can after this, but I think Tom gets to speak now, and I get to be quiet because I'm losing my voice now from running so many meetings today with this. Thank you very much, Hugo, for giving me the time.
Thanks very much, Thomas. Tom, would you like to share your screen?
Sure, let's do that. There, how's that look? All right. So I guess, should I just take it away, Hugo? So thanks for that glowing introduction, Thomas. I won't say much more about us then, because you've already done such a good job of introducing us. But anyway, here we are. Here's our website address and email address. We'll come back to that later. And just a quick bit about myself and our firm. So our firm is a registered investment advisor in the States. In the US, there are two types of financial advisory firm, the brokerage firms and the registered investment advisors. I started this company in 2002. We have clients in about 35 countries now. And what makes us quite a bit different from a lot of the firms in the US is that almost all of our clients are Americans living abroad. About 90% of our clients are US expats. And we offer two flavors of services: investment management and financial planning. A little bit of background. I'm a chartered financial analyst as well as certified financial planner. And I used to be an expat myself. I was originally an engineer. I worked in the oil services industry for a company called Schlumberger internationally in many different places, including Thailand briefly. And now I've been doing this for over 20 years, dealing with expats, and those are basically our clients. And so here's what I'm going to talk about, and I'm going to try to keep it relatively short here. But as Thomas already mentioned, it's very difficult these days for Americans to actually find financial institutions in the States that still want to deal with them. It's a little bit easier on the banking side, more difficult on the brokerage side. So we're going to talk a little bit about who you can deal with and what they can do with you, a little bit about currency considerations and moving money back and forth, I'll touch a bit on estate planning, although Thomas already talked a bit about that, and then we'll talk about what's going on in the investment markets these days, what we're looking at, what we're doing, and finally we'll finish it off with some expat issues and a little bit about financial planning. So let's talk about expat-friendly, U.S. expat-friendly banks and brokerage firms. And I just want to, I'm sure there are others, but these are the four that we recommend that we kind of deal with as well. So first of all, on the banking side, on the currency transfer side, there's a company called Wise. It used to be called TransferWise. They started out as a currency transfer and exchange service. More and more, they're turning into a bank. They're even offering pretty good interest rates on deposits held within Wise these days. Still a good way to move money around, pretty competitive exchange rates as compared to going through banks. So that's one good way of moving money back and forth, and also you can keep some cash on deposit with them if you like. Then there's the State Department Federal Credit Union, sdfcu.org. They are the credit union that caters to people working in U.S. consulates and embassies around the world. And so they're also another banking option for you if you're overseas, and they offer a full suite of banking services. They're a credit union, and the nice thing as well is you can open an account online, which is pretty rare. Most places you have to walk into an office. So because they're used to dealing with expats, you can actually open an account online, and so they're also pretty easy to deal with as an expat. On the brokerage side, we use two firms. So as a registered investment advisor, we don't hold our clients' money. It's held at what we call a custodial firm, which is a U.S. brokerage firm. And we use Interactive Brokers and Charles Schwab because we find them to be the most expat friendly. Interactive Brokers will deal with Americans living practically anywhere, except for OFAC countries, like places like Libya and so on, Iran. But basically, pretty much anywhere, Interactive Brokers will deal with you. Schwab, it's country specific, but they're also pretty good at dealing with expats. There are some places that they do not cater to. Philippines is one. Italy is another. There are a few countries they won't deal with, but they're generally pretty good at dealing with Americans living abroad. The big difference between the two is that Schwab is a bank as well as a brokerage firm. Interactive Brokers is not a bank. So with Schwab, you can get a debit card, you can get checks. With Interactive Brokers, you really can't do that. Interactive Brokers does offer multi-currency accounts, but they're not very user-friendly. Schwab is much more user-friendly, much better on the on the client service side as well. Although typically our clients will go through us for that kind of a thing anyway. So then moving along to the next topic, I'm going to just touch on this really estate planning considerations and things that I see, questions I've gotten over the years. So first of all, in terms of U.S. retirement accounts, the key there is to ensure that the beneficiary designations are set up correctly. And, this can change over time, but basically you have primary and contingent beneficiaries. Typically, if it's a married couple, you might have the spouse as the primary, and then the children, if there are kids, as contingent beneficiaries. If something happens to both the account owner and the primary beneficiary, the contingent beneficiary is the account. It's important to note that the non-U.S. person can be a beneficiary on U.S. retirement accounts. You don't need to be a U.S. citizen. You don't even need to have a social security number. So it is possible to set up your non-U.S. resident spouse, for example, as a beneficiary on your retirement account. For non-retirement accounts, it's a bit more tricky. So if you were in the U.S., you could attach what's called a TOD designation, transfer on death. But if you don't have a U.S. address on the account, because the TOD comes under state law, if you live outside the U.S., you actually can't have a TOD designation. So TOD works just like a beneficiary for a retirement account. So if you have a non-U.S. address on the account, you can't have this. And then you need to think about, well, if something happens to you, how is this account going to be passed to whoever you want it to pass to? Probably the most clear-cut way to do it is if you don't mind having your beneficiary on as a joint tenant. But then the flip side of that is they become an account owner as well. So you have to be comfortable with that situation. But if a joint tenant is on the account, then that person just basically gets the account upon the death of the other person, the other account owner. That's joint tenants with rights of survivorship. The other way, if you don't want to have a joint tenant on the account, is you can have a will or a trust arrangement. Trusts are particularly flexible in the sense that you can put almost anything you want in terms of provisions in a trust, and also it's nice if you want to dole out funds over time. Like, for example, if you don't want all of the money to go to, say, your kids before they turn age 25 or whatever, then a trust can be used to dole those funds out over time. Trust can also be professionally managed if the person who will be inheriting perhaps isn't very financially savvy, they're not used to managing investments, then it can be professionally managed, as can obviously a retirement account or a joint account. One thing to watch out for in terms of a trust is if you're setting up a U.S. trust and you want it to remain a U.S. trust, then the majority of the trustees have to be U.S. persons, and so they have to be citizens or residents of the U.S. And so sometimes this comes up if, say, you have a husband and wife who are trustees. The husband is a U.S. citizen, the wife is not, and they don't live in the U.S. And then the husband dies, and then it becomes a non-U.S. trust, and that has entirely different tax implications under U.S. law. So that's one thing to watch out for. And in those instances, you might want to have a corporate trustees. There are companies that provide trust services and U.S. corporate trustee, and that way it's always a U.S. trust. So let's talk a little bit about what's been going on in the investment world and what we're seeing and where we're putting our clients' money these days. So one of the things that's been really important over the last few years is that interest rates have gone up, right? Inflation went up. As a result, interest rates went up in the U.S., in Europe, and many other places. And so that has affected a fundamental change in how you might think about a part of your investment portfolio. At least a few years ago, it didn't really make much sense to put money into bonds or bond funds, and because you had relatively low yields, you had interest rates at almost zero, you got very little from bonds, and if interest rates go up, then bond prices go down. So if you're in a long dated bond fund, especially, then when interest rates go up, you actually lose money on that fund. And people think of bonds as conservative investments, but yeah, if you're in a long dated bond fund, like a 20-year treasury fund, and interest rates go up, that fund could go down a lot in capital gains terms. So now that interest rates have gone up, though, it's the other environment. It makes sense to once again put money into bonds, especially on the conservative side of the portfolio. And now we're looking at an environment where interest rates might even go down over the next little while. I don't expect them to go down as much as other people do in the U.S., but probably they'll go down a bit. And so that's a great environment for putting conservative funds into bonds, into bond funds, into longer maturity bond funds as well, because you can get a decent yield on them now, and the price will go up if interest rates go down. So I would think a pretty good investment, especially for the conservative side of the portfolio right now. And so we talk about, interest rates are so high, but they're not really that high. So keeping it in perspective, here's a chart of the Fed funds rate going back to the 50s. And as you can see, the rates we're at now are really only about average. I mean, there have been some times like during the oil shock and in the early 80s where OPEC was driving prices up and inflation went up. Interest rates were up a lot higher. And generally over history, the rates we're at now are not excessively high. So we shouldn't really think of them as high interest rates. We should probably think of them as something average. I also don't expect, as a result of that, I don't expect them to go back down to zero. I mean, it would take, I think, a big recession or something like that to drive rates significantly lower than they are now. So I don't think we should have the expectation that they will go down by 2 or 3% in the next year. That's unlikely to happen, barring some kind of a cataclysmic effect in the U.S. economy or economies around the world. And so here's where we are with bond yields now. On the short end of the spectrum, if we're looking at the, say, U.S. Treasuries, you get about 5%. On the long end, you've got about 4%. And actually in the middle, it's lower than that. So it's kind of a strange yield curve, you know, a normal yield curve, lower rates, or because you're locking your money in for a shorter period of time, the lower short dated interest rates are usually lower than long dated ones. That's what we call a normal yield curve. For a while there, the yield curve was really inverted, where the high rates went up so quickly that the longer rates didn't keep up and they were lower, and we still see that a little bit. So what's probably going to happen if interest rates go down is they'll go down mostly on the short-term rates. So those short-term rates will come down, and that's why it's a good time maybe to extend the maturity if you're investing in bonds and part of your portfolio. Let's talk about the stock market. So a lot of people are looking at this and they say, "Oh, the market, especially the U.S. market, has gone up so much," but you know, it's kind of been mostly the technology companies that are driving that, the growth companies, what we call growth companies, and specifically we're talking about the Magnificent Seven now. You know, Apple, Tesla, Meta, Facebook, Google, those kinds of companies. They're very volatile, but they've done very well recently, and that's really what's been driving the U.S. market. And that's also why some other markets, like you look at the UK, you look at the European markets, in comparison, they haven't done as well for a couple of reasons. First of all, they don't have the Magnificent Seven, but then secondly, they generally have a lower weighting to technology. In general, like the UK market has practically no weighting to technology. And so we've seen these growth companies go up, but what we call the value companies, which are more stable companies, maybe you buy them for the dividends, you don't expect the earnings to go up as fast. The value companies haven't gone up as quickly. So there's still value in value, I think. There's not so much value in growth these days. So that's one thing to keep in mind. And these days we're shifting more of our investments to the value side, actually, the stock market investments. And here's just an example of what these technology companies. So here you have the Magnificent Seven, or six of them anyway, that we're looking at. So in 2022, I mean, look at what happened there. So Facebook was down 60% in 2022. You know, the S&P 500 was down about 20%. All these companies were down way more than that. I mean, you look at even Apple, very big stable company, down a lot more than the S&P 500. Amazon was down 50%. So that was in 2022. And then the next year, 2023, well, they're up. I mean, Facebook's up 194%. You know, Apple's up almost 50%. The S&P 500, I mean, don't forget these stocks are in it as well. So they were driving that up. So these companies have done pretty well, but they're also very volatile. So it's a good idea to have some diversification for most people. You know, obviously, if all you're interested in and you don't mind the volatility, then sure, that's technology is a nice place to be. But you should bear in mind that these are very volatile investments sometimes. And so if we look at value versus growth over 3 years, you can see the purple line, the value companies are much more stable. They've also kind of gone sideways over the last 3 years, whereas the growth companies have gone up and down, and they've kind of ended up on a 3-year time span almost at the same place. So depending what you're looking for, if you're looking for, say, retirement, more stable type investments, that would be more the value company sides. And certainly over the last 10 years, growth has outperformed value by a big chunk. And so I think now is the time to maybe be looking more on the value stock side. Another thing to look at is emerging markets. So here's the S&P 500, the purple line, versus an emerging market index. And you can see that in the early 2000s, when we were talking about the Asian tigers and China and all that, emerging market stocks did much better. But then came along the financial crisis in 2008, and basically emerging market stocks fell off a cliff. I mean, the S&P 500 didn't do very well either, but emerging markets went way down. And then they recovered in 2009, but they've kind of gone sideways since then. And so I think there's also some value in emerging market stocks now, and we've got some companies. Mostly we will buy exchange traded funds on the emerging side, and so we have some money in places like India, not so much in China these days. We're still a little worried about that market, not quite sure what's going on there. But in India, we had some a little more far-flung markets, some money in Turkey and Mexico and places like that. So I think the emerging markets are also not not a bad place to have some money now, also for diversification purposes. And then for people who are retired, they talk about income. And you can get income in many different ways, but it doesn't just have to be from bonds. You know, bonds, obviously, CDs, cash, interest type investments, but also you can get income from things like dividend-paying stocks or for preferred shares, which are kind of between stocks and bonds. Preferred shares, a lot of the banks issue them. You can get maybe about a 6% dividend yield there. Real estate investment trusts, maybe not the greatest place to be now, depending on what kind of a REIT it is, but REITs come in all kinds of different flavors. Some of the REITs that are doing well right now, for example, are the ones that offer storage space to server farms, you know, with the AI and computers in general becoming sort of expanding. Server farms are doing pretty well. So those are also structured as REITs. We have a REIT called Iron Mountain in the portfolio, which provides they hold data storage for other companies, you know, physical files and so on securely. So they've done pretty well. And there are all kinds of flavors of REITs, and you can get pretty good dividend yields there. BDCs, business development corps. This is like publicly traded private equity companies that invest in a lot of maybe 200 or 100 risky companies, and that pay them high interest rates, and those transfer to investors in the form of dividends, and they pay maybe 10% dividends, BDCs. Master limited partnerships on the oil side as well. The thing about these is they might issue a K1, and if you have that in your IRA account or something, you might have to pay tax, even though it's in an IRA account, what we call UBTI, unrelated business taxable income. So watch out for those K1 forms. And then there's things like infrastructure funds and actual real estate that you can also get income from. So many different ways to realize income in your portfolio if you're so inclined, and a lot of people look towards that. And good diversification as well compared to the stock market and compared to other types of investments. And then just a quick word about financial planning, which is the other service we offer. You know, when you start up with any kind of a financial advisor in the States, you end up doing this risk profile questionnaire, the intent of which is to say, well, how should this portfolio be structured in terms of risk? Should it be very aggressive, 100% stock market? Should it be very conservative, maybe 30% in the stock market? So that's the risk profile questionnaire, but that just tells you maybe how much risk you're willing to take on. What a financial plan can tell you is what rate of return you might need on your investment to realize your financial goals. So for example, a lot of people might use it for retirement. They don't want to outlive their savings, right? So there's a budgeting aspect to it. What's your income? What are your expenses? What are your assets? What rate of return do you need on those assets in order to not run out of money if we're talking about retirement planning? Another way, so it helps you optimize your income strategy that way, optimize your investment strategy because it can tell you what rate of return you might need. It can also help you optimize your income strategy. Sort of a rule of thumb that we've used over the years is if you take out 4% of your retirement savings, then you'll never run out of money. And this is based on historical data over 30-year time periods. So 4% is a kind of a rule of thumb, but if you optimize, you can optimize the strategy by, for example, taking more money out in years when you have good investment returns, and less money out in years where you have poor investment returns. And instead of that 4% rate of return, then you might be able to get like a 5% or even higher rate of return not rate of return, but withdrawal strategy in retirement without running out of money. So ways to optimize it: financial planning. Also, expat issues that we already talked about, those are also part of financial planning, and making sure the portfolio is diversified. You know, a lot of people come to us and they say, well, I've got money in a bunch of different stocks, emerging markets, Europe, US. But the thing is, all those stock markets go up and down together, more or less. Some do better than others, but they go up and down together. So true diversification means also putting some money into some of the other investments I mentioned here, and maybe some others. Like, for example, we have about 10% in gold right now, and gold is a good diversifier at times as well. And then estate planning considerations, we already talked about that, and consider different income streams, not just from investments, but you might have property, rental property, or something like that. So also a good way to diversify your portfolio, and all of that comes under the guise of financial planning, which is the second service that we offer on top of investment management. And so I'll end it there. And just a word about us: we're based in San Francisco. Our clients are all over the world in about 30 countries, and feel free to reach out to us. We also will do a free half-hour consultation to discuss your specific situation. So thank you for the time, and I'll pass it back to you, Hugo.
Thanks very much, Tom. Thank you both for those excellent, informative presentations. We've kind of gone over time. There are a few questions, and I think maybe if we just try and cover a couple of them. And I think some of them are fairly personal. I'd say to our audience, if you have specific questions for your situation, reach out to Thomas and Tom via their websites, AI Tax Advisors with knee.com and IAM Advisors with no.com in the advisors. So reach out via the websites if you've got personal questions. There are a few questions about whether you need a Thai tax identification number. That's been a theme. So maybe that's a question for Thomas.
Okay. I'll hit several questions here. Okay, if you are a resident in Thailand for more than 180 days, whether a permanent resident or even on a tourist visa, you're going to be subject to Thai taxation. Okay, and Thai taxation reporting. Okay, now what they are telling us is that next year you will have to file a Thai tax return with this, unless a minister steps in on this. So that question of, am I going to file a Thai tax return? You've been in the country on more than 180 days. You're supposed to file some tax return. Enforcement wise, they can go in, and when you try to come in the country and say, they look up your visa and say, did you file a tax return for that year? And you say, no, they cannot let you back in. And even if you're in country and you haven't filed it, they've given us a list and say they can deport you. If they really consider you egregious, they can put you in prison for 7 years with this. They are actively planning on enforcing this right now. I thought until the Thai government recently changed, they might hold back on that with it, but they're moving forward with this, guys. We have a staff member, generally 1 to 2, in the Thai revenue office about a kilometer away from us, talking about this issue every day. This is coming down the pike sooner rather than later. Yes, as a firm, we are the only firm that I know of that files both U.S. tax returns and Thai tax returns for all nationalities living here in Thailand. With this, we are because we've been dealing with the Thai U.S. tax treaty so much, we are the absolute experts on that. Give us questions on this. In fact, one gentleman asked about Australian superannuitization. If you are a government employee, no, it's taxable only in Australia. If you are an individual, it's taxable only in Thailand by the tax treaty, but they may not tax it based upon Thai rules stated by a minister, but that's not been put in place yet. If you got a question with that detail, give us a call with the free half hour. We're available to it. The other common question that keeps popping up here is, do I need a Thai tax ID number with that? Okay. We are saying in order to file a Thai tax return, you will need a Thai tax ID number. If you have the pink residence card, you already have the Thai tax ID number. If you have a Social Security card, you already have the Thai tax ID number. If you do not have either one of those two, or they don't think you have a Thai tax ID number, you can go down and get this on your own. However, we're getting about a 20% success rate from people doing this on their own. We are currently doing this for 7,000 bots. We send people down every day. They're limiting us to 10 applications a day. Believe it or not, they do have a specialist, and we have a 100% success rate on getting these Thai tax ID numbers. So if you are in that situation, you're concerned about the tax issue. Actually, Asa, who's watching this, is one of my staff members who's sort of running this right now. Give us a call at the free half hour. We're running 8 to 9 meetings on this every day right now to this. And again, there's no cost or compliance. You can go somewhere else, but we do give you yes and no answers and tell you what's going. There are still a lot of unknown answers because the Thais themselves have never done this before. So there's a lot of answer questions on that. But yeah, I think that probably hits the majority of the questions with this. A long time visa issue on this, theoretically, you are going to be free of Thai tax with this. They have stated they think you won't have to file a Thai tax return, but they have not put that in full rules yet with this. And Admin at aitaxadvisors.com. You can Google us. We also have phone numbers. You can give us a call anytime. Asa or Chris would be helping you out in doing that. And okay, now the other question here is if I leave and return, I have 180 days to remit money into Thailand. It doesn't work that way. Okay, guys. The 180-day rules is during a calendar year. So you can't stay here, leave for one day, and come back and then remit unlimited money when you're gone. You spend 180 days in this calendar year, you're tax resident. That means you can spend 3 months in one period, 3 months in another, and one more day, and guess what? You've hit Thai tax residency with us. So, and that's for then you're tax resident for the entire year. It doesn't lose. It's all based upon number of days in the calendar years. So theoretically, you could spend 160 days at the end of this year, and then 160 days beginning of next year, and you've got almost a whole year here, and you're not tax resident in either years. It's just based upon 180 days in that calendar year. With this is a gift. Yes, if you transfer a gift from your Thai bank account to anybody else, it's also a gift, not taxable to the individual receiving it. But that doesn't really help you with the remittance basis rules. Because if you send that from your foreign account into your account, it's going to be taxable to you, and then not as a gift to them. If you're going to give a gift to try to avoid the remittance basis, you need to send the money through from a foreign account to your spouse or the other individual from a foreign account into that individual's local account with this. And oddly, you can be sitting next to them. It doesn't matter where you are. It's a matter where the money comes from with this. We're not sure yet on the $10,000 cash rule. Do not exceed that. You're hitting anti-money laundering things to this. Whether or not they're going to start asking you at the airport and whether that counts as a remittance, they haven't ruled on that one yet, but for God's sake, do not exceed $10,000 because you're breaking U.S. rules and Thai rules, and you can go to prison with this. Social Security card. No, there's a Thai Social Security card as well with this, which kicks in on this. Don't ask me to look for what it looks like. I don't have one of those myself. There is a pink residency card that a lot of expats have here. Tom's sort of looking at me through the video, like, what is he talking about? Because he's not used to dealing with this. But yeah, if you have the pink residency card, that does have your tax ID number on it, but it's got to be issued in like the last 10 or 14 years with this. Filing date for Thailand is March 31st. However, extensions are able to be done. The ATM rules, okay, guys, on this. Right now, they're not doing the pulling money out of an ATM or credit cards with this. However, in the general international rules, you can hit what's called structuring, where you're doing transactions to avoid them. So they could come back to haunt you in the later points. So you can't really say I'm just living off of ATM withdrawals. Right now, that's a loophole you could use, but it can come back to haunt you if they determine that you are structuring your funds to be outside of that. With this. And by the way, government pensions in the U.S., if you're a government employee with this, are only taxable in the United States by the tax treaty, and not taxable in Thailand. So we get a lot of guys who weirdly do this are oddly military disability, and those guys, it's also considered a federal pension, but you do need to be a federal employee to meet those rules with it. States are not subject to the tax treaty due to state sovereignty issues with this. Sorry guys, I've done these pretty quickly. If you got a specific question, give us a call. We're glad to help you out and do that. There's no charge to give us a call. We're glad to help you out with this thing, through this. So, there's a lot of questions. I think if there's anything I can add in this at the beginning with this is, Tom mentioned planning. I've mentioned planning. Planning when you're living overseas can give you huge advantages on everything you do with this. Especially when you're dealing with two different tax regimes on this. And this isn't even just for Thailand. We have offices all over Southeast Asia and even in Saudi Arabia. Those guys still have to plan for how they deal with stuff, even though Saudi Arabia doesn't tax their income to this, but they can use things and use strategies that help them out with this. Strategizing this stuff, guys, makes you more tax efficient. Ideally, we've always done, the wealthy have always done this internationally. We as a firm and groups like IAM have pushed that information down to where it's affordable to you. We make this, to where this is reasonable and affordable. It's part of the reason my company is growing so fast. We're now, as far as I know, the largest in Southeast Asia, and soon will be one of the largest in the world, because we're trying to make this affordable and help everybody out with this. to it. So give us a call. We can help you out.